Hi everyone, this is Gautam. So welcome to module 7 of this business valuation learning series where we will be valuing this Indian healthcare provider, Koi Medical Center and Hospital. So in this video, we would be talking about the various ingredients uh, and the technique that is needed to value business. Okay, and then we will value this company. Okay. Now, your comments and your feedback until now has been very helpful. It kind of motivates me to go on with this video series. Okay, and I also got some feedback that the last two modules were pretty lengthy, and they were lengthy because I was modeling the balance sheet, the financial statements, and linking them, and so the video got very lengthy. And uh, so all the feedback well taken, but see, these are like education videos and these are not like entertainment videos. So I'm hoping that 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 you are a serious learner, and the best way to learn is that you pick up this company and you value this model and value this business with me. Okay, and obviously you can reach out to me if you have any questions. I'll be more than happy to help you. Okay, I'm very passionate about this subject. Okay, so so in this video, although I don't promise that this would be a short video, uh, but I'm not going to spend a lot of time explaining each and every concept. I'll just cover every concept like risk-free rate, equity risk premium, so on and so forth. I'll cover all these concepts to the extent they are needed uh, for you to be able to value a business. Okay, all right. Uh, so and then I can always I can make separate dedicated videos, long videos on each of these concepts, like equity risk premium, beta, cost of equity, and so on and so forth later. But again, these in this module also we'll cover all of these concepts, but not at a great length of detail. Okay, all right. Okay, so all right. So let me get started. Uh, Let me open up a whiteboard. Okay. So please watch the first video, the introduction to valuation video, because I'm going to build up on that video. But so let me do a very quick recap, like how do you value a business? Okay, so value of a business is the present value of its expected free cash flow. Okay, so so if you want to value a business, you want to assess and estimate the future cash generating ability of a business and estimate what is the value of that future or expected cash generation today. जो फ्यूचर में फ्री कैश फ्लो जनरेट होने वाला है और हो सकता है उसकी वैल्यू आज की डेट में क्या है. दैट इज व्हाट that is how you value a business. Okay, so and at a high level, what is free cash flow? Yeah, and obviously we'll get into details in this video. So free cash flow is the excess cash that's left with the business, or it's a surplus cash that's left with the business after it meets out its uh, capital expenditure and working capital needs. Okay, so this is what it is. So a business generates profits. Okay, in high level. Okay, profits minus net capex minus uh, change in working capital. And working capital we've covered in the introduction to valuation session and the later subsequent modules as well. Working capital is nothing but your short-term liquidity. Think of it as the money that's stuck in your day-to-day operations. Think of working capital that way. All right. So this is what mota free cash flow really is, and this is what you need to estimate in the future. Okay, and then estimate the present value of all those future cash flows today. Okay, right. Now, okay. See, there are two capital providers to a business. Okay, one is the equity holders or equity providers who are also called the owners of the business. Okay. And the other are lenders. Okay. These are not owners of the business. Okay. They lend money. Okay. And they charge you interest. Okay. So, so, so if there is a, let's say if there is a, if you have to, if there is a liquidation. Okay. So in the liquidation hierarchy, okay, lenders would have to be paid off first if there is a liquidation. Okay. And then equity holders. So equity holders, they are the last in line. First lenders would have to be paid off and then equity का number आखिरी में आता है. Equity are the owners are the last in line. Okay. पहले अपने उधारी को खत्म कर लो, उधार चुका दो, उसके बाद मालिक को बाद में मिलेगा पैसा. Okay. All right. So this is what the liquidation hierarchy really is. Okay. So now when we value a business, okay, so the free cash flow, okay, that is made available, which could be distributed to equity holders, is called free cash flow to equity. Okay. And the free cash flow, okay, which could be made available for distribution to both equity. Oh, pardon my handwriting. Okay. Both lenders and equity holders. It's called free cash flow to the firm. Okay. So these are your two capital providers. The free cash flow, okay, available for distribution to both the capital providers is called free cash flow to the firm, and the free cash flow, okay, available for distribution to the owners, the equity holders of the business, as I said, is called free cash flow to equity. Okay. All right. So when you estimate free cash flow to equity holders, okay, all right, and then you discount it to the present. We'll talk about discounting in detail in this video, but just be with me right now. When you estimate free cash flow to equity, okay, in the future and discount it to the present, okay, the value that you get is called fair market value of equity. Okay, it's called fair market value of equity. Okay. And when you estimate FCFF, free cash flow to firm, okay, and then discount it back to the present, okay, the value that you get is called fair enterprise value. Okay, or EV. Okay. So this is what the, at a high level, what the difference between FCFE and FCFF is. Okay. To whom the value accrues to. Okay. That is how you make the distinction. Okay. All right. Now, okay, what is the relationship, by the way, between enterprise value and market value of equity? Okay. So enterprise value is market value of equity plus debt minus cash. Okay. So say if you want to buy a business, okay, you would look at enterprise value, because if the business has some debt, it has some udhari, okay, you'll have to take the debt too. Okay, you just cannot buy market value. You'll have to take on the debt too, and we'll pocket the cash. Okay, so that's why you look at enterprise value. What is traded is obviously the market value, the market capitalization, as we call it. So market capitalization divided by number of shares is the share value or the stock value. That is what is traded in the market. Okay. All right. And FCFE, through this method of valuation, you would estimate the fair market value of equity. All right. Now let's go further. Okay. Okay. Now let's double click on free cash flow to equity. So free cash flow to equity holders, you start off with profit after tax. From that, you net out net capital expenditures. You also net out change in working capital or short-term liquidity. That is the money which is stuck in your day-to-day operations. Okay. You add any new debt issuances. Okay. And you remove any principal debt payments. Okay. So that you need to net off. Okay. And why do you need to net off debt payments? Because remember I said equity holders are the last in line. Okay. So first, so any cash flow that would accrue to equity holders would be post payments to your debt holders. Okay. पहले उधार जिनसे उधारी ली है उनको पैसा दे दो, उसके बाद जो बचेगा वो इक्विटी के पास आता है, इक्विटी होल्डर्स के पास आता है. ऑलराइट. And by the way, this also has interest component. Okay. So the interest that would accrue on these debt payments that has already been accounted for in this profit after tax. Okay. Because this is the profit that's left after you have taken account all the expense items, including interest. Okay. All right. So this is what your free cash flow to equity is, and this is what you have to estimate in the future. Okay. And discount it to the present. Right. So I just opened a new whiteboard. Okay. So you need to estimate your free cash flow to equity in the future and then discount them to the present. And that would give you the fair market value of equity. Okay. But for how long you need to estimate your free cash flows in the future? Okay. So that judgment you'll have to make depending upon what stage of life your firm or the business that you've chosen is in. Okay, say if the firm is young, if it's a young growing firm and you believe it has a long runway of growth ahead of itself, then the forecast you need to be estimating your future free cash flows for say 15-20 years. Okay, but if the business is has matured, if it's a mature business, then you may just want to give it a you may just want to forecast cash flows for just 5 years in the future. Okay. Right. But so let's understand it. Okay. Through this formula. So fair, then you'll understand it better. Fair market value of equity. Say your forecast period is n. Well, let's say it's 5. Okay. Let's say so n equals 1 to 5. So for each of those 5 years, you need to estimate your free cash flow to equity. Okay. All right. And then discount them to the present using a certain rate of return. Okay. Yeah. So 5 years, since our n is 5, so 5 years you estimate cash flows and discount them to the present. But what happens after 5 years? Say in DCF, okay, an assumption is made. That your business operates forever. It operates in perpetuity. Okay. So after 5 years, okay, there is something called as terminal value. And again, we'll get into details of terminal value, okay, later in this module. Okay. But essentially, after 5 years or whatever your forecast period is, okay, you estimate a terminal value using a, a formula, which is really Gordon growth model. Okay. So it will help you estimate the terminal value of your business and it makes your life easier. Otherwise, okay, if had it not been for this model, you would have had to estimate future free cash flows for perpetuity, which obviously is not practical. Okay. So Gordon growth model, this just helps us estimate the terminal value so that we don't have to estimate cash flows for each and every year in the future. Okay. And we'll cover terminal value later in this module, as I said. Okay. All right. Now, it's said free cash flows and even the terminal value, by the way, needs to be discounted to the present. Okay. All right. So now, what's this R? What's this discounting rate? Okay. See, if you again, if in case, I'll suggest that you please go to the module 1 video in which I've covered the time value of money. Okay. So let me give you a quick recap before I explain what this R is. Okay. What this rate of return is. Okay. So, all right. So let's say this is year 1 and this is year 2. Okay. So in year 2, let's say you have $100. So what is the value of that $100? So $100 next year, what is the value of that $100 today? Okay. So if the inflation rate is 4%, okay, so the value of that $100 next year is really 100 divided by 1.04, which is 1 plus. So if R equals 4%, which is inflation, okay, so the value of $100 next year really is 100 divided by 1.04. Okay, so that is around $96 today. Okay, all right. So basically, the way to think about this is that if you are able to buy something for $96 today, that is this year, okay, same stuff, okay, you would be able to buy for $100 next year. Okay, right. So you have to pay $4 more next year for the same good or service that you were able to buy for $96 today. Okay, all right. So what it means is, okay, another way to think about is that say an investor at the bare minimum would want to beat inflation, the inflation rate. Okay, say if they have $96 today, okay, that $96 should become $100 next year. If it doesn't become $100, say if it becomes only $99 next year, then that means the investor is losing money. They're not able to beat inflation. So at the bare minimum, they need to beat inflation. In fact, let me take it back. Not only inflation, an investor, along with this inflation, they also need to beat the real GDP growth rate. Let's say the real GDP growth rate is 3%. Okay. 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 So they need to beat this 7% at the bare minimum. Okay. In fact, think of this 7% as your 10-year government bond rate, the rate at which government borrows money. Okay. So at the bare minimum, an investor would want to beat 7%. Yeah, otherwise they are losing. They're really, because why would they invest in this business if they're not able to make that 7%? By the way, think of this 10-year government bond yield to be loosely equal to inflation plus real GDP. Okay. So, but get the notion, get the idea that at a bare minimum, okay, an investor would expect to earn the government bond yield. Okay. All right. So in India, the 10-year government bond yield is closer to 7.2% right now. Okay. So that is the bare minimum return expectation that they would have, that an investor would have. Okay. Now, but there is one thing more. Okay. An investor would say, why would they invest in any business when they could just invest in, say, the government bond, right, and make 7%, 7.2%? Okay. Why they would invest in a business? Because a business has its own risks, right? Why they would invest in a business, right? So if they're investing in a business, they're taking on more risk. So they would want to be compensated for that additional risk that they take by investing in that business. And they need to be compensated for that risk. Okay. All right. So they expect a higher return than the government bond yield. All right. So let's talk about that. So we were talking about uh, the return an investor expects if they invest in a company or a company which operates in the equity market. Okay. So let's try to understand this further. So the return expectation, okay, of an investor is they expect the 10-year government bond yield, okay, plus they expect an additional return because they have to be compensated for the risk that they take by investing in the equity market, or a company which operates in the equity market, right? So they have to be compensated for that additional risk. Okay. So this 10-year government bond yield, as I said, this could be roughly thought to be broken into two things. One is the inflation rate, okay, plus the real GDP growth rate, okay, roughly. Okay. So, and this 10-year government bond yield is considered to be risk-free. So if you're investing, say, in the Indian 10-year government bond yield, which is 7.2% right now, it's thought to be risk-free. The investor thinks that they're going to make this rate any which ways. Okay. So it's considered pretty safe. Okay. But there is, let me add a caveat, there is, it's not entirely risk-free. Okay. But we'll cover that. So there's a small caveat. So we'll cover that later. But the US, if you're investing in a US 10-year treasury bond, okay, it's considered to be risk-free. Okay. And so this risk-free rate, okay. So if you're so it's actually derived from the currency. So if your valuation is in INR, Indian rupees, you have to take the Indian government bond yield. But if your valuation says in US dollars, you have to take the US risk-free rate, or the US 10-year government bond yield. Okay, we'll spend more time on that. Okay. So now I was talking about the additional return. So if the investor, if they invest in a company or in the equity markets, let's talk about if they invest in the equity market, if they invest in the BSE Sensex or in Nifty. Okay. So if they invest in the index, they are taking on the additional risk of the equity markets, right? Okay. So they expect a higher return. So let's call this equity risk premium. Why premium? Okay. Because this premium is over and above this risk-free rate. This premium is over and above this risk-free rate. That's what they expect. That's why they've come to the market, because they want higher return. Yeah, otherwise they would be just happily investing in the government bond yield. वो तो उनको पता है वो तो मिलेगा ही. So that's why they've come to the market, because they expect a premium. Okay, and why it's risk? Because they're taking the risk of the market, right? So this is also called, by the way, this is also called the price of risk. Okay. All right. Now, I've said that they invest in the equity market. Now, say if they invest in a company which operates in the equity market, right? Any company you pick in the, say, in the Indian equity market, right? So the company obviously would have exposure to the different market risks that are out there. Okay. So if say they invest in any company, if they invest in a TCS, okay, or if they invest, let's say, if they invest in L&T, okay, so L&T definitely would have some additional exposure. Okay, so what we do is we scale this by something which is called as beta. Okay, all right. So this, let me write it here, and I'll explain this obviously. So the return expectation of an investor investing in a company operating in the equity market is risk-free rate plus beta times equity risk premium. And beta, okay, it measures a company's exposure to the different market risk or the different macroeconomic risks. So it measures exposure to market or macro risks. Okay. So because say let's try to understand this. Let's try to understand this. Okay. Say uh, if your company makes, say, indiscretionary products. Say if the company makes high fancy Louis Vuitton bags. Okay. So when you have a tough macro environment, okay, when there's a recessionary environment, uh, who do you think is going to buy those bags? Okay. So the sale of that company would be impacted, right? Because not many people are going to buy those indiscretionary items. Okay. All right. So there is an additional risk, okay, of investing in that particular company. Okay. But if you are investing in that risky company, okay, because it makes indiscretionary items, so when the times are bad, okay, all right, there'll be more risk in that company. So an investor would expect a higher return because that company is risky. It has it has a lot of risk vis-a-vis the market. Okay, but say if your company is a grocery retailer, those are like discretionary items, right? You would buy grocery regardless of the macroeconomic environment. And say if you alcohol companies which make alcohol, people are going to like buy alcohol regardless of the macroeconomic environment. If perhaps they would buy more in a recessionary environment, right? So they are considered less risky. Okay, so their beta would be, so beta for say discretionary companies which make discretionary products and services would be, it may be like less than 1. Okay, beta for discretionary companies which make indiscretionary products and services would be greater than 1. Okay, so they have more risk than the market. And beta for the market itself, if we just invest in the index, the beta for that is 1. Okay, so you just take on the equity risk premium. All right, but depending upon the company you invest at, okay, the company could have could be more risky or it could be less risky. So beta is really a risk measure. Okay, all right. So or if your company has very high fixed costs, okay, very high fixed costs, all right, then also the company is perceived more risky vis-a-vis from the other companies operating in the market. Then also your beta could be greater than 1. So you take on more overall risk. That's why you have to be compensated for that additional risk. All right. So, and we'll estimate both beta and equity risk premium. Right. I'm just trying to explain you the concept at a high level as to how this works. Okay. And by the way, this risk-free rate plus beta times equity risk premium, okay, this is called as your cost of equity. Okay. Cost of equity Because see, think of this uh, as your minimum return expectation. Okay, an investor expects, obviously they would, in an ideal world, they would want to make higher return, but this is what they need to make. Okay, think of this that they think of this that this is what they need to make to break even, so to speak, on the money that they're putting in. So that's why it's called the cost of equity. Okay, this return expectation is called the cost of equity. Okay, risk-free rate comes from the currency, beta comes from the company, okay, that you have picked, measures exposure to the macro risk, and equity risk premium comes from the country of operation. So this equity risk premium comes from the country of operation. So say if you are valuing TCS, Tata Consultancy Services, yeah. So although it's an Indian company, but it gets bulk of its revenue from North America and then I think from Europe. Okay. So what do you think the equity risk premium should be? I know we have not estimated equity risk premium yet, but the country of operation is 50%, say, it gets its revenue from the US. So you have to take the equity risk premium of the US market, 50%, and say 20% is from, say, Europe. So you have to take the equity risk premium from the other market, and whatever revenue they make from India, then you have to take the revenue of the Indian market. All right. So equity risk premium depends upon the country of operation. That's how you should estimate it. So we'll definitely understand how do you calculate equity risk premium and beta for your company. All right. All right. Okay. Now, uh, by the way, this is also called this cost of equity, equals risk-free rate plus beta times equity risk premium. This return expectation, this mathematical model, or this equation is also called CAPM, capital asset pricing model. The mathematical model which describes this relationship of calculating the return expectation by investing in an asset or a business is the mathematical model is called capital asset pricing model, because you're essentially pricing the risk of an asset to determine its return expectation, right? Okay, and again, I could spend more time on it, okay, but perhaps then this video is going to get very long, okay. So I'm just trying to cover the extent to which is needed for you to understand valuation, okay, and for you to kind of use all of these concepts, okay. Uh, all right. So now let's dive into beta a little more before we estimate beta, and then we'll estimate equity risk premium as well. Okay. So let's dive into beta a little bit more. Okay. Let me open up a new whiteboard. Okay. Just making sure I'm recorded. Yes. All right. So beta, move my pick up there. All right. So we said beta captures the market risk or the exposure of a company to market or macroeconomic risks, right? So there are, say, two types of risks that we were talking about here. One is the market risk. Okay. The other is the company specific risk or the firm specific risk. This is R, by the way. Pardon for my bad handwriting. Okay. All right. So there are two types of risk. This market risk is also called systematic risk because this is the risk in the system. Okay. In the system, in the market. That's why it's called systematic risk. Finance people, they love to use fancy words. Okay. All right. But whenever someone talks about systematic risk, just think of the macroeconomics or the market risk. Okay. And firm specific risk is, it's just specific to the company. Okay. It's called unsystematic risk. Obviously it's called, one is called systematic. These would be called unsystematic risk. Okay. All right. Now, systematic risk. Okay. All right. This cannot be diversified. Okay. So I'm introducing another concept. Cannot be diversified. What does it mean? Okay. What does it mean? This can be diversified. Okay. What does it mean? Can be diversified, cannot be diversified. See, we are saying market risk cannot be diversified because see, if you're investing in the equity market or company in the equity market, that risk you'll have to take any which ways. There is no way of there is no way escaping that. Okay, that's why you're expecting a higher return, no? Because you're investing in the market, so that risk you'll have to take. वो रिस्क तो लेना ही पड़ेगा. Otherwise, बॉन्ड में इन्वेस्ट करो, छोटा रिटर्न कमा लो. But market where you are investing, you have to take on that risk. So that risk is not going anywhere. Okay. What is this firm specific risk and why we are saying it can be diversified? Okay. All right. Okay. Say uh, if you are if you are invested in multiple companies, you are taking on if you are invested in multiple company, or if you are an institutional investor, you are invested in multiple companies. Okay. Then though, okay, you obviously have market risk, but you have minimized the firm specific risk, no, because you're invested in multiple companies. Okay. All right. But say if I am a small retail investor, I don't have a lot of money. Okay. And if I just put my small amount of money in one company, okay, all right, then I'm actually exposed to both market risk and firm specific risk. Okay. All right. Then what do you think the cost of equity would be? Okay, see, if I'm a small investor, okay, all right, I just said beta measures the market risk, the exposure of a company to the market risk. That's what beta really measures. It measures this market risk. I did not talk about any risk measure which covers the firm specific risk. But if I'm a retail investor, if I put my money, as I said, in a company, what would be my return expectation? See, I would invest, my expectation would be, I'm taking a lot of risk of the business. Okay, not only the market risk. I would expect the stock to, do very well, Uh, so, but it's, perhaps, I would expect, that company like becomes a multi-bagger in say a couple of years or in 1 year itself. Okay, so my return expectation is huge because I am taking the firm specific risk as well, along with the market risk. Okay, I may be being irrational as well. Okay, but if you have an institutional investor, okay, all right, okay, those institutional investor are well diversified. Okay, they are invested into a lot of companies. Okay, so they would, for them, okay, uh, the cost of equity that we just derived, okay, that so this beta really makes sense for them. All right. And by the way, these institutional investors, they also could be called marginal investors. So what is a marginal investor, by the way? Again, a finance word. Okay, jargon. Yeah. See, if a marginal investor is an investor who has a lot of stake, significant stake in a company. Okay. And if they make a trade, okay, then they have that their trade has the potential to move the price of the company. Okay. So I, as a retail investor, okay, I have small amount of money, I have a very small stake, which is like really insignificant. Regardless of whatever trade I do in that company, the stock is not going to do anything. Okay. But a okay, marginal investor, if they have a significant stake, like say your institutional investors, your DIIs, your FIIs, okay, if they make a trade, then their trade has the potential to move the price of the company. All right. See, in valuation of public companies, an assumption is made that the marginal investors are diversified. Okay. So it allows us to focus on the risk that cannot be diversified away and use a beta to capture that market risk. Okay. Right. But if I am if I am not, retail investors are like may or may not be diversified. If I, as a retail investor, am not diversified, I'll take not only this beta risk, I'll take additional risk as well. And there is a way you could estimate that as well. Yeah, but I'll get to that later. But when you value a public company, you use this market beta because this entire cost of equity and whatever concept we discussed until now, cost of equity equals risk-free rate plus beta times equity risk premium. This is from the perspective of a marginal investor who is diversified, okay, and not from the perspective of undiversified investors, because undiversified investors would take not only market risk, they would take a lot of firm specific risk as well. Okay. All right. Okay. All right. So hope this concept was clear. And if in case, and I know I covered a lot of things, but if it's not clear, please feel to write to me and I'll happy to, clear your doubts. Okay. Now let's talk about how do you estimate beta, the market risk measure. And then we'll also touch upon and how you can use that beta to estimate this firm's specific risk measure as well. You may not use it in the valuation of public companies, by the way, but I'll throw some light here as well. Okay, it may come in handy. Say if you are valuing a private company which is not listed. Okay, say if you are if you're buying a if you as an investor you have some money, if you are buying a private business, let's say, and you are not diversified, okay? So yeah, then this beta could come in handy, but I can spend more time when when we get into the estimation of beta. Okay, so let's cover that next. Okay.